Good afternoon, this is Blake Young and you're watching the TheoTrade evening video for December 22nd, 2022. Tonight we discuss bulls freeze and bears thrive in the cold. We are very aware that the bomb cyclone is hitting many parts of the country. We know that temperatures are at 30-year lows in some parts of the country. Wind chills have pushed temperatures below -75, and we really hope that everybody can stay healthy and safe and frankly warm during the next couple of days. Please be safe, and we really hope and wish you the best. Now, the markets kind of got chilled out today as well. And we know that when the markets get cold, when things get cold, bears thrive. You know, allegorically, bears thrive and bulls freeze during cold, cold weather. And sometimes the bears have that extra layer of protection, but it's really the bears thrive because in a downward move, we can see higher volatility and better opportunities for the downside and for the bears. We saw that today. Interestingly, we saw that with GDP, or gross domestic product, outperforming. Normally speaking, gross domestic product is considered the largest, broadest measure of economic health of any economy. GDP, final GDP, reported at 3.2% today. 3.2% is not only a recovery from 2 negative quarters, which is usually considered a recession, but that recovery would say, hey, we're out of the recession. So not only did we see the signal that we're out of the recession with the 3.2% rate, the 3.2% rate is almost 0.3 or 10% higher than the expected rate of 2.9. The 3.2% rate is higher than 2021's December report, or 2019, and all the way back to 2018. So we're seeing a solid, stable growth rate according to gross domestic product. And normally that would be an indication that the economy is doing great. We should be fine. We should be looking for growth and expansion. It's roughly the target that the Federal Reserve wants to see. But the fact that that rate is there is showing we have an extremely resilient economy. We look at yesterday's consumer confidence, which caused this bounce through here. And because of that, we're seeing that the market is pricing in higher interest rates. Higher interest rates from the Fed, more rate hikes possibly in February and March than what we previously thought, because the economy is so resilient. We also know that this week we saw the Bank of Japan even get into the game of letting interest rates naturally, or through the economy's band that they let it trade in, the 10-year rates can go all the way up to 0.5%. Well, we're seeing that move and that change all through the major central banks. If all the central banks are raising rates and expanding, the cost to borrow goes up. And if the cost to borrow goes up, then all the companies, primarily tech companies, that borrow the most, will see higher and higher costs to grow, higher costs to develop, higher costs to do everything, which means as they borrow and they pay more, their earnings will slide. And if they pass on those costs, those higher costs to borrow, then those costs will be passed on and demand will come down. It'll be delayed as those costs are passed through, but that demand will slide, and that demand is going to be delayed. The question is whether we're going to see that decrease in earnings starting in January. Are we going to see that rate hike faster in February? Well, the market certainly started pricing it in. As you can see, we sold off far enough to erase all the way back, all the bullishness that we gained, all the way back to the Fed meeting back in November. We've created all these higher highs, higher lows, but we talked about this last week. We have this expansion pattern. If I'm going to mark this up, this is an expansion pattern. We're seeing widening in price action over the last couple of weeks, and we broke through the downside. A widening pattern in the longer time frame, it tells you that we're seeing a new trend develop. We talked about that last week. Well, we broke down and retested this new expansion as old support became new resistance, and confirmed that it's not just an expansion saying look for a new trend. This is a confirmation of a bearish trend, rejecting old support as resistance and confirming lower highs and lower lows. Not only did we do that, we did that on an even smaller basis, meaning today's high was higher than yesterday's high and today's low was lower than yesterday's low. So we see even expansion here in the very short term, 2 days, confirming that we're seeing a continuation of that downtrend. Taking a look at the intraday price action, going into the 5-day 15 minutes, you see how aggressive this sell-off was. The Nasdaq saw even more significant sell-off, as we said, because the technology sectors have a tendency to borrow more. We reached a negative 3.5% rate in technology, communications, the Nasdaq, and still settle in about 2.5% down for the day in those tech sectors and the Nasdaq. As you can see at the top, the S&P ended down 1.5%. Great recovery here. Solid recovery starting about 1:30 Eastern. Higher highs, higher lows, and even parabolic. The problem is that we had sustained selling and an aggressive bounce. As we look at where these levels are playing out to, we see that there was a sell-off right after the open and a pause. As you know, I love to see these areas through here that have a large bullish candle and an even larger red or bearish candle absorbing that. That tells me there's probably still sellers that wanted to sell at about 38.50. This recovery traded right to that level and paused. It appears as though we probably have another leg down. Whether we break today's lows or not, we probably have another leg down. And if we just retest the lows and we go from the current, well, the close price down to that low, that could see another 1.5% drop. We could finish the last couple of days at a 4% drop in the market. And if we look at the moves from the recent rally, that aggressive bullish move from the peak that we saw on CPI, from that high to the low, that's almost 10% just off of that time frame. We've now changed the trend and we're pushing lower, but a lot of this is still dependent upon what the economy is going to do. Is it resilient enough to justify raising rates for multiple days, multiple weeks? Are we going to see a continued sell-off? Are we going to reach and retest the lows through here by the end of next week? Are we going to see it retest the lows down to 3,600, which I think is a reasonable target for the S&P by the end of the year? A lot of that will depend on that rate hike pricing in and the dollar. Let's take a look at the dollar index so you can see what's happened there. The dollar index is the dollar compared to a basket of currencies. The dollar is just holding. It didn't really rally that much. It's just sitting here and holding its support. If the dollar does rally and the dollar sees a move from 104 to 105, 107, then you really could expect the equity market to drop back and retest annual lows. But the key again is, what are we pricing in for rate? If we look out to the Fed funds futures for February, you can see there's a ZQG23. We're pricing in a price level of 100, subtract this right here, 95.35. And if we were to put that into a number that we can digest as an interest rate, that would be about a 4.655. So we're pricing in a 4.655 rate for February. Well, what is that? What does that equate to? According to the Fed funds futures, we're pricing in a 4.665. We're theoretically somewhere between 4.25 and 4.5 currently. So let's call it 4.375. We're pricing in a 25 basis rate hike. And if we were doing a 25 basis point hike, we would be right in here, roughly in that level right through there. So we're pricing in one rate hike of 25 basis points for February. If you look at the CME Fed Watch tool, they're pricing in a 67% probability of a 25 basis point hike. We didn't have that right after the Fed meeting this last month. Let's go look at March. If we're to price in March, and I'll just move this over, we'll take this view of H23 and look at the Fed funds futures. What are we pricing in for March? 95.285. If we're going to price in this March rate, we take 100 and we subtract off the 95.285, which leaves us with 4.715. So 4.715 puts us to a 50 basis point hike, roughly, as we're going into that March timeframe. Now I'm going to go ahead and put, again, 4.375. We're pricing in most of 50 basis points into that next move. If we look at the Fed tool and project out all the way out to March, instead of the February meeting, and look out to the March contracts, we're pricing in about a 55% rate hike to that probability of a somewhere above 4.75 to 5%. So already pricing in near 5%. In fact, a 21% probability that will be above 5% by March. So markets are absolutely pricing in higher and higher. The fear and concern is how much that stops growth, how much that stops earnings before it actually impacts inflation. A couple of other things to pay attention to as we go into these final weeks of the year is as we see money moving around and trying to find safety. We are not pricing it in gold prices. Let me show you the gold December contract so you can see where we're at. And you can see that big sell-off. We're not really pricing it in. Gold is not any different than it was back in November, so we've eliminated any inflation pricing into gold, and we've dropped back down and erased all the growth from this week in gold prices. It doesn't appear that we're hedging inflation because we are betting more and more on the Fed and the central banks around the world to continue to raise rates to stop inflation rates. And one more time to reiterate, higher rates will likely negatively impact the Nasdaq and tech stocks more than some of the other stocks. And as you can see, even from the distribution point of view, the monkey bar point of view, the volume profile type of scenario, this is a strong bearish exit of an overbought territory, and we will likely retest at least 10,700 before the end of the year and possibly even reach and surpass the annual low on the Nasdaq before the end of this calendar year. Strong bearish move. Watch for a small bounce, and it does look like we will probably try to retest the short-term lows. Something that you can expect to see going into tomorrow, in addition to just the continuation or the momentum of the bearishness today, is core PCE price index. PCE, or personal consumption expenditure, is the #1 tool that the Federal Reserve uses to define inflation. They use PCE more than they use CPI. Consumer Price Index is a great measure of inflation, but the Fed pays much more close attention to personal consumption and expenditure. As they watch that PCE, if it is higher than the 0.2% than they expect, the analysts expect, then you and I can expect even more aggressive pricing in of rate hikes and even more selling into tomorrow's market ahead of the holiday weekend. So be careful, be safe. Be safe whether we're talking about the markets and the cold there, or be safe if you're talking about actual physical cold. We'll look forward to talking to you again later. Have a great day and see you tomorrow.